Hi, thank you for tuning in. I hope you caught the last episode. Shifting gears a little bit for this episode, a friend of mine sent me, or rather tagged me, on a Facebook post that he shared on his timeline. And it was an article written by, I think, a PhD student on the issue of land in Kenya, land and properties in general in Kenya being grossly overpriced, and how the bubble is beginning to show signs of bursting. I'm going to be sharing my own opinions and thoughts on this, so stay tuned. You're watching On Land in Kenya. I'm Solomon Wangwe. So is the bubble bursting finally, as we've heard people talk about? This is something I've heard for about 10, 12 years now. The bubble's about to burst. The bubble's gonna explode. Get out now. Wait until it bursts before you get in. We're still waiting, and I think there's good reason for that. I'll just start from taking us back a little bit. It helps to understand historical cycles before you draw conclusions. So the whole thing of the bubble bursting, largely based on what happened in the Western world, in the States and Europe, parts of Europe, where the real estate market crashed because of a massive abuse of the credit facilities. Subprime loans is what they used to call them. I happened to be living in the States during this period, and I was actually in the real estate industry then. I used to buy and sell houses. I'd buy homes in poor condition, fix them up and resell them. And we did this right up until the bubble burst. So I have real experience of this whole scenario. And so when people talk about the bubble bursting in Kenya, it's made in reference to what happened in the States with regards to this. And I think it's a grossly mistaken perspective, because either people don't understand what caused the bubble burst or something else. So first things first, what caused the bubble burst in the States? Subprime loans basically means people who were not credit worthy were getting facilities to buy homes. In many cases, they were getting facilities for higher than the home prices, because they'd get 100% financing plus closing costs plus everything else. So it wasn't uncommon to see 105% mortgages. And I remember I knew someone who had a dog in his household, and they received, on a weekly basis, they would receive pre-approved credit cards from all manner of banks and credit card companies. And one day he was shocked to find that he had received in the mail a credit card in his dog's name for $2,000, a $2,000 limit credit card for his dog to spend. This was something that he didn't need to call to pre-approve. You just needed to go to an ATM to activate it and withdraw the money. So, this happened on a very large scale, and things kind of caught up. A lot of people were unable to service their mortgages because these were adjustable rate mortgages, or ARMs, as is typically referred to. Adjustable rate mortgages means you get the loan at a particular rate, but the lender has the right to adjust the rate with no notice to you, and you still have to make the payments. So something happened in the global economic scale of things, and the rates adjusted upwards to almost double what they were when people got the mortgages. So imagine this: you're paying a mortgage at 7%, and then next month you're told you have to pay the mortgage at 15, 16, 18%. Your income was not enough to take up the extra amount, and so you defaulted on your mortgage. In the States, typically, if you default for a period of 90 days or 3 months, then foreclosure processes begin. And foreclosures are a very bad thing for lenders, because lenders are not in the business of taking over property. Lenders are in the business of earning interest income. And so what happened is, all of a sudden, all these banks had massive inventories of properties that they had to foreclose on, because the owners, the buyers, were not able to service the mortgages because the interest rates shot up and they weren't able to make the extra payments. And then what tends to happen is the banks then sell off these assets for pennies on the dollar, for a fraction of what they are worth, because it's better for them to sell off this property, say it's worth $100,000. The mortgage that the person owed on it was maybe $90,000, so it's 90% leveraged. It's better for banks, and this was commonly done, for them to sell that property off for $30,000, in some cases as low as $20,000. That's called a short sale. They sell off these assets because their point is to remove these foreclosures and these non-performing assets from their books, because if they don't, it affects their credit rating and they may not be able to access funds as institutions at favorable rates as well. So this was, domino effect. And you can imagine, if you're in the market, you want to sell your home for $100,000 because it's worth $100,000, but 10 homes on your street are going through foreclosure and the banks are willing to let them go for $30,000. Whose home do you think is going to go first? And all of a sudden you have to heavily discount your property in order to compete. And even if you weren't selling the property, its value generally was perceived to be lower because the new selling prices had come down. And that's how the bubble burst in the West. And so, if you transfer that dynamic to Kenya, there's a few problems. First is that in the West, credit facilities were easy for most people to access, especially with the whole subprime market nonsense that kind of triggered this whole thing. I just shared with you, I knew someone whose dog got a pre-approved credit card for $2,000. In Kenya, it's a completely different thing. It's quite the opposite. Credit is not easy to come by. The last report I read, I believe, said there was something about 32 to 35,000 mortgages in the books in Kenya in entirety. I mean, South Africa records over 30,000 mortgages in a month. And that's what we have in Kenya in totality. I'm not sure what period of time those mortgages are accounted for, but that's all the number of mortgages in Kenya. Now, if you think about places like Westlands, Upper Hill, Langata, Kileleshwa, Lavington, Buruburu, I mean, think of every neighborhood you can. Just in Nairobi, forget the rest of the country, forget Mombasa, forget Kisumu, Nakuru, all these thriving towns in Kenya. Just think about Nairobi. How many properties do you think there are in Nairobi? Honestly, I don't know what the number is, but I guarantee you there are several times, the number of mortgages in the books for the whole country. And so what that suggests is we have a completely different set of circumstances to deal with when talking about bubble busting, because very few people access mortgages to buy property. They pay in cash. Kenya is a cash buying market. And so when you talk about prices coming down, you have to think about it a little bit differently. I will concede that we do have a seemingly oversupply of commercial, high-end residential and commercial space, especially in Westlands and these kinds of places. And so it's natural that prices may stagnate and even begin to come down, whether it's for sale or leasing. We're already seeing a slump in rental rates in places like Lavington and Kileleshwa because there's an oversupply for one reason or the other. But to claim that property in Kenya is grossly overpriced simply because you can't afford it, that doesn't make any sense whatsoever. I know of an acre in Upper Hill that's currently on offer for 1.2 billion shillings. 1 acre. 1.2 billion, that's $12 million for 1 acre in Upper Hill. Recently, the news publication stated that Upper Hill in Nairobi is the most expensive real estate in Africa outside of Sandton in South Africa. That's a crazy statement to make, but it is true. And so while we might complain about prices is too high, it's gonna bust, it's unsustainable, there are people spending this money on this land. The price is not that way because someone woke up one day and randomly decided to pick on a number. This is what buyers are willing to pay. Yes, many of them are not locals. I mean, you look at Westlands, already happened in Kilimani and extending into Upper Hill. A lot of these are being bought by Chinese entities who are awash with cash from their country. And so, $12 million for an acre of land for them is nothing for a couple of different reasons. Number one, it costs them very little. For you to get access to $12 million here in Kenya, you will pay a premium for the facilities if you don't have the cash yourself. In China, it's not uncommon for them to have those facilities from their government for as low as 2 or 3%. And even then, those interest payments are deferred for many years. So it's affordable capital for them. Secondly, they come from a place where their exposure and knowledge about what to do with that acre is vastly different from what a Kenyan, a local like myself, might be able to imagine doing with that acre. So, I'm not gonna pay $12 million for an acre because I might think of putting up a 12-story building if I can afford to after spending $12 million just for the land, right? But for a Chinese entity coming in with cheap access to capital and a vision to put up a 43, 61-story building, mixed use commercial, they can justify the cost because they can reap that back when they sell or lease. So all these factors come into play. And when you talk about land being overpriced, not understanding historical precedents and current dynamics, including the reality that Kenyans are simply outpriced in their own market, does not mean that then the bubble will necessarily burst. It just means that most of the property will now be sold to foreigners with bigger spending power and a bigger vision on what to do with the property. So that's my two cents on the issue of land being overpriced in Kenya. You have to look at each segment separately. You have to look at commercial space separately from residential, and even within residential, you have to segment that further from high end to mid-range to low end. And even each of those segments can be further striated. You can't treat the whole industry in a blanket manner. That would be misguided, foolish, and I might even say ignorant. So do your homework. As with all things, read, look for journals, investigate, ask questions before you disqualify yourself from reaping value in all the many opportunities that there are in our own country for us to build value and create wealth for ourselves and future generations. If you have questions, comments to make, please feel free to do so. Subscribe to our YouTube channel. Give us a call at 07 001 001. Again, that's 07 001 001. We'd be happy to engage with you and debate this further. You're watching Own Land in Kenya. I'm Solomon Wangwe. Stay tuned for more information on strategic land investment.